Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today is the start of a series of AMA episodes. In fact, it relates to one set of questions, but there's a lot to this question, so it's going to take a couple of episodes to properly answer it. The question comes from Adam in Riverside, California, and he's asking about corporate debt and how much of a risk corporate debt presents to our financial system. Before we can begin to answer that, I think it's important to take a few minutes and talk about the different investment grading systems that exist for rating debt instruments. So we're not going to answer Adam's question today. We'll answer that tomorrow. Today is going to be a little bit of a tutorial on the different rating systems for debt products, whether they be investment grade or non-investment grade. The most widely known of the rating systems is based on a company called Moody's, and they have the Moody's rating scale. Now, the rating scale can be applied to a variety of different borrowers. So, for example, in some cases, Moody's is evaluating the borrower. In other cases, they're evaluating a specific financial obligation. Today, Moody's evaluates over 100 sovereign nations, over 12,000 companies, over 29,000 public finance issuers, and 96,000 structured finance obligations. So it's important to understand, are you looking at the borrower? Are you looking at a specific fund? Are you looking at a specific financial obligation? Because Moody's rates all of them. Now, generally speaking, the debt falls into two large classifications, what's called investment grade or non-investment grade. Generally speaking, things that are non-investment grade are considered to be speculative and are subject to higher credit risk. The rating system is based on letters A, B, and C, and that's further broken down into A, AAA, AA, single A. They have a total of 10 ratings in the investment grade classification, and they have a total of 10 in the non-investment grade. For example, AAA, and I'm quoting directly from their guidebook, these are obligations that are judged to be the highest quality with minimal risk. Once we get into the non-investment grade, for example, the BA1, these are judged to have speculative elements and subject to substantial credit risk. Once you get into the C, these obligations are C-rated, and they're the lowest rated class of bonds. They're typically in default with little prospect of recovery or principal and interest. Of course, one of the reasons we had the credit crisis that happened back in 2008 is that many of the bond rating services misclassified debt obligations. They packaged obligations that had a combination of both high quality and toxic assets mixed together, and it made it very difficult for the rating services to unwind the reality of what was going on underneath the covers, and they were misclassified as being much higher quality than in fact they were in reality. Now, when we talk about banks, they have a different rating system. These are, again, rated through letters A, B, C, D, and E. Banks that are rated A have superior intrinsic financial strength. They're going to be institutions with high value, very defensible business franchises, and strong fundamentals. They're very predictable, and they operate in a stable environment. At the opposite end of the spectrum, banks rated E have very modest financial strength, have a high likelihood of periodic outside support, and need for eventual outside assistance. These institutions might be limited by one or more of the following factors: either a weak or limited business franchise, financial fundamentals that are materially deficient in one or more aspects, or an unpredictable and unstable operating environment. In many cases, when you're dealing with bond ratings, what you're in fact evaluating is not the bond itself, but the strength of the financial institution or the company group. When you're dealing with a company rating, Moody's tends to rate a corporate family and look at a corporate family's ability to honor all of its debt obligations as opposed to a specific debt instrument. It doesn't reference the obligation of a single class of debt and really makes no reference to the priority of claim. So, for example, you may have more senior debt or more junior debt. Moody's pays no attention to that. They look at the overall corporate family's ability to meet all its debt obligations. Now, to answer Adam's question, I did a fair bit of research, including sitting in on several talks from the World Economic Forum that was held just this past week in Davos, Switzerland. Karen Fang from Bank of America had some great statistics on the global debt picture. She reported that global debt 10 years ago across all forms of debt was about $100 trillion. Today, it's sitting at $170 trillion. It's a fairly significant increase in global debt in just 10 years. Now, global debt to GDP ratio has also gone up. It's not enough just to look at debt. You've got to look at how much the world economy has grown over that decade. Now, we haven't had a 70% increase in everything because, of course, the monetary value of the economy has grown, so the ability to service that debt has grown as well. But still, in spite of that, the global debt to GDP has gone up by 25% in the past decade. So there, too, we are really taking on significantly more debt. Now, out of that $170 trillion, $66 trillion is corporate debt, and that corporate debt has grown by $29 trillion. On tomorrow's show, we're going to break down this debt in a lot more detail. We're going to look at some very specific cases and try and answer the question, how much of a credit risk to the global economy does corporate debt represent? Thank you, Adam, for a great question. And before you listen to tomorrow's show, take a look at your own debt structure. How much has your debt grown in the past 10 years? Have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.